This $25 hack can pay you every month. Baby bonds are a low-key passive income investment anyone can start, as long as you know about one catch called a call date. In this video, we'll break down exactly what baby bonds are, 3 key benefits, like steady monthly income and high yields, 3 major drawbacks, like low liquidity and call risk, and explain what a call date means for these investments. Stick around. Whether you're a new investor or a seasoned pro, you'll learn something new about this niche of the bond world. What exactly are baby bonds? Baby bonds are simply corporate or municipal bonds with a lower face value, par value, than traditional bonds. Most regular corporate bonds have a minimum face value of $1,000, but baby bonds typically come in denominations of just $25. By issuing bonds in these smaller chunks, companies make it easier for average investors to buy in without a large upfront investment. Apart from the smaller denomination, baby bonds function just like any other bond. They pay fixed interest, a coupon rate, at set intervals and return the principal at maturity. In fact, many baby bonds pay interest quarterly, and some even pay monthly, providing a frequent income stream for investors. Maturities can range widely, often 10 to 30 years until the bond comes due. Baby bonds can be issued by similar entities as traditional bonds. For example, corporations like utilities, financial institutions, or telecom companies, specialized finance companies like BDCs, business development companies, and even municipal governments for funding projects. One important note, many baby bonds are listed on stock exchanges, such as the NYSE or NASDAQ. This means you can buy and sell them through your brokerage like you would a stock. The exchange listing is convenient for access, but as we'll discuss, it doesn't guarantee there's always a buyer waiting. Liquidity can be low. Also, don't confuse these investment baby bonds with certain government baby bond programs for newborns. The same term can refer to different things, but here we're talking about the investment bonds available to everyone. Benefits of baby bonds. Baby bonds come with several attractive features for income-focused investors. Here are 3 key benefits. Steady income, monthly quarterly payments. Baby bonds provide regular interest payments, which can serve as a consistent income stream. Unlike many traditional corporate bonds that pay interest semi-annually, baby bonds often pay quarterly, and some even pay every month. This means investors could enjoy a monthly flow of income, making baby bonds appealing if you want frequent payouts to cover expenses or reinvest. Relatively high yields. These bonds tend to offer higher interest rates, coupon yields, compared to many larger investment-grade bonds. It's not uncommon to find baby bonds with coupon rates in the 5% to 8% range, which is quite high in the bond world. Why do they pay more? Often it's because they come with more risk. For example, the issuer might have a lower credit rating or the bond is callable. Investors demand a bit extra to compensate for those risks. FINRA.org. The result is a higher yield on baby bonds, which can boost your overall return if the issuer remains healthy. Low entry point. Affordable to investors. The most obvious benefit is the low entry cost. With most baby bonds priced around $25 per value, virtually anyone can start investing in them. You don't need the $1,000 minimum that a standard bond might require. This lower barrier makes it easier to diversify into bonds. You can buy small amounts in different issues or sectors. In short, baby bonds offer an accessible way into fixed income investing for those with limited capital. Disadvantages and risks of baby bonds. Of course, baby bonds are not perfect. Along with their perks come some notable downsides. Here are 3 major disadvantages to keep in mind. Liquidity risk. Baby bonds can be hard to sell quickly. Many issues have relatively low trading volume, so there might be few buyers in the market on any given day. This illiquidity often leads to a wide bid-ask spread, the price gap between what buyers are willing to pay and sellers are asking. FINRA.org. In practical terms, if you needed to sell your baby bond before maturity, you may struggle to find a buyer at a fair price. You could be forced to accept a lower price than you want, especially in a hurry or during market stress. Interest rate sensitivity. Like all long-term bonds, baby bonds are sensitive to interest rate changes. When overall interest rates rise, the market prices of existing fixed-rate bonds, including baby bonds, tend to fall. This is because new bonds will come out with higher yields, making the older ones with lower coupons less attractive by comparison. So if you hold a baby bond and interest rates surge, the value of your bond on the market could drop significantly. Additionally, since baby bonds trade on exchanges like stocks, their prices can be a bit more volatile, sometimes moving with stock market sentiment as well as bond math. That means you might see price swings in your baby bonds over time, even if the issuer is doing fine, simply due to interest rate trends or market fluctuations. Early call risk. Many baby bonds are callable, which means the issuer has the right to redeem the bond early, well before the maturity date. Typically, a baby bond can be called, bought back by the company at par value, starting about 5 years after it's issued FINRA org, though the exact timing is set in the bond's prospectus. Early call is a risk for investors because if the company calls the bond, your interest payments stop sooner than expected. You get your principal back, but you lose the future interest you were counting on, FINRA.org. For example, imagine you planned on 30 years of quarterly interest from a baby bond, but the issuer calls it after 5 or 7 years. Suddenly, that income stream is gone. To make matters worse, called bonds are often redeemed when interest rates have fallen. Companies call their debt to reissue at cheaper rates, leaving you with cash in hand that now earns less elsewhere. A reinvestment risk for you as the investor, FINRA.org. In short, the callable feature protects issuers. They can refinance if it benefits them, but creates uncertainty for you. What is a call date? In the context of baby bonds, a call date is a specific date from which the issuer is allowed to call back, redeem, the bond if they choose. This is usually the first date the company can exercise its right to pay back your principal and stop paying interest. For most baby bonds, the call date arrives about 5 years after the bond's issuance, though it can be set shorter or longer. Here's how it works. When a bond hits its call date, the issuer can decide to pay you the par value, typically $25, and retire the bond early. They might do this if, for instance, interest rates have dropped and they want to reissue debt at a lower cost. As an investor, you don't have a choice if the bond is called. You'll get your money back, but you won't receive any more interest after the call. Essentially, the call date marks the point in time when long-term might not end up lasting so long. It's also useful to note how the market anticipates call risk. If a baby bond is trading above its par value, say it's priced at $26 or $27 in the market, and the call date is approaching, investors know there's a chance the issuer will call it at $25. As a result, the market price often drifts down toward $25 as the call date nears. The closer the call date, the more you should expect the price to hover around par value, because nobody wants to pay, say, $27 for a bond that could be redeemed at $25 in short order. This is an important dynamic to understand when evaluating the potential upside and downside of a baby bond nearing its call date. Outro. Your take? Baby bonds can be an interesting addition to an income portfolio, offering accessibility and high yields, but also coming with unique risks. Now, we'd love to hear from you. Do you own any baby bonds? If so, which ones, and what has your experience been? Let us know in the comments below. If you enjoyed this deep dive or learned something new, give this video a thumbs up and subscribe to the channel for more financial insights every week. Thank you for watching, and until next time, happy investing.